So a big question for this market, should we expect Washington and Beijing to hold their fire? Morgan Stanley says no, and they write the following: this round of tariffs will likely be put into place and investors should behave as if further escalation will happen in 2019. The negotiating positions and the macro backdrop reveal that each side perceives that the benefits of standing one's ground outweigh the benefits of cooperation. I want to talk to the man behind that note, Michael Zezas now. He joins us, Morgan Stanley's head of US public policy. Michael, always great to get your insight. Just explore that a little bit further for us, what you're looking for.
Yeah, well, I think there's two important observations here. I think the first is that if you go back to when talks broke down on May 5th, I think both sides are actually further apart now than they were back then. Back then, the issue was about these kind of key structural issues of enforcement of IP protections, whether or not existing tariffs would go off. But since then, we've had another round of tariffs go on, another round of tariffs be threatened, a kind of détente at the G20, which both sides are still arguing about the conditions of those, what can be done about Huawei, what can be done about ag purchases. And so as a consequence, you got the latest tariff threat last week. So those differences have widened out. And at the same time, we've been arguing the structural incentives for both sides to escalate have gotten larger as well. So on the U.S. side, it's about the Fed reaction function. The administration probably feels somewhat emboldened by the idea that the Fed is likely to ease if trade tensions go higher. It's probably got an eye on 2020, which is to say that the more you escalate now, the more potential easing you get from the Fed, the longer time you have to kind of frame a response if something goes wrong ahead of the election. And on China's side, the incentive isn't necessarily to escalate, but it's to hang tough and not necessarily make concessions, because the U.S. is still asking for things that at this point it seems like it's just not willing to concede around long-term structural economic changes.
Michael, can you identify where the off-ramp is to avoid further escalation? Can you identify what that is in the next 4 weeks or so?
I think there's a few potential off-ramps, but none of them seem either likely or comforting to investors. An obvious one would be if markets go down further, it sort of reframes the payoff structure for both sides, which is to say that so far, at least in the U.S., there hasn't had to be a reckoning with the economic risks of tariffs from the administration standpoint. It's been able to escalate without seeing a material downturn in the U.S. economy or a material downturn in markets, not recent volatility notwithstanding. So a greater downturn in either the data or the markets might very well reframe that for the administration. But again, that's not very comforting to investors because it means you have to have market weakness before that happens.